what exactly is gaining right now. Look at how reopening trades are actually panning out. Banking's stocks are at the top of the heap right now, but other broader market trades such as hotel stocks, wherever there is a semblance of reopening which is happening, then risk on. Look at that, ICICI Bank, not only a good result, but Axis, all of them 4-5%, SBI 3%. So let's take the discussion forward with our guest on the show today. Rajesh Kothari of AlphaAacurate is here with us. Good afternoon, Rajesh. Rajesh, you're also of the view that right now there is no sense to be very cautious and defensive. And that is how you're also positioning your portfolio, tilted towards risk on via financials. Thank you so much for joining us. Explain to us what's your hypothesis for that argument.
Well, I think Ajay, if you look at just 1 year back, rewind 1 year back, last March, April, COVID was like unknown, correct? And you look at today, it is a known unknown. I mean, we know at least half of the things, vaccine has already come and so on and so forth. So I think probably the worst is behind us. In terms of COVID, whatever can happen, and that's what the global opinion is from the scientist perspective. And always market is always ahead of time, so you cannot try to bottom out everything and try to time the bottoms. This is absolutely not possible. So I think economic recovery, if you look at that case, that remains very, very strong, and therefore it is better to right now take more exposure towards the recovery plays. Now, when you look at economic recovery, it can be banking and finance, it can be capital goods, it can be proxy consumer plays, which also can recover, if the economy continues to recover, and many more such names. And that's the reason why I think cyclicals, are better. So we had a very big exposure earlier in defensives, but during last year we have changed our positioning from defensive to cyclical. We again got this opportunity to again increase the weightage in cyclical. So, that's how we are doing it from strategy perspective.
Right. With the disclaimer that whatever stocks we are talking about are only for indicative purposes, but still you may have, or clients or the fund may have interest. But just wanted to understand how exactly are you playing the financials? Is it private sector banks, is it PSUs or select NBFCs? Can you explain to us with examples?
Okay. So basically in banking and finance, I think winner takes it all. Because banking and finance is something very, very, when economy is going to recover, but the entire SME is going to take some more time before their profitability comes back. So the asset quality risk, it is different depending upon which bank you are selecting. And that's the reason why I think from the investors' perspective, it is better they stick to the large banks, the large organizations rather than the very small companies within the banking and finance. So from the portfolio perspective, please put a disclaimer. There are companies which we own, like for example, ICICI Bank, on which we are very bullish, HDFC Bank, which we continue to own, HDFC we own, we own of course in NBFC, number one, like Bajaj Finance, in consumer financing. Similarly, we are holding Cholamandalam in, what I would say, commercial vehicle financing, and, one or two more such exposure. So I think banking and finance, it is a winner takes it all. Capital allocation is very, very important. Asset quality risk is very, very important. And this is not a time to venture into, small NBFCs. I think we still have some more time, maybe another 2, 3, 4 quarters before we look into such names.
Sure. Valid point. In fact, just also let's play the commentary of ICICI Bank management in the con call. The stock is gaining 5%, and Rajesh too was explaining his rationale of being positive on that side of the market.
The Indian corporate and even SME sector, I believe, has become a little more resilient than what they were last time. They have gone through a fair bit of challenges over the last 1 year. They have also done their pieces on digitization. And I think they should be in a better position to hold on this year. But stress testing is a part of a regular exercise which any bank does. So we have been doing this, and we are comfortable with the results.
Let's move forward and talk about the space which you really like, and you have worked historically quite a lot on, that is specialty chemical and agro. I understand you've been adding some names, fresh names to the portfolio, both from one side of the market, which has already done very well, but perhaps a new phase or new leg of growth is getting added, but also some side of the market where stocks have really not done anything for the last 10 years in the agrochem space. Talk to us about both of them and what triggers you see ahead.
So Ajay, as you rightly mentioned, specialty chemical, agro as well as non-agro, this is a space which we have been bullish from last, 3, 4, 5 years. On the non-agro side of specialty chemical, very important, is that when you look at these companies, you need to look at the capital expenditure side of it and the competence of, from the management perspective, from the business model perspective to scale the growth. And most importantly, what kind of a new product launches you are doing it if you are on the agro side of it, correct? Thanks to China Plus One and of course the competence of the Indian specialty chemical companies, we see huge growth upside potential to continue to be there in both agro as well as non-agro side of specialty chemical. We have been looking at new names to add in last 3, 4, 5 months, and we have identified few names. I would not like to name those companies, but again, as you rightly mentioned, these are the companies which are established companies. So the growth was probably missing in last 5, 6, 7 years. But now the capex plan they have already announced, and we are comfortable with the management and the business model, and I think there can be good upside. So I would not like to put a name on it, but I think this is a space which investor keep under radar, and I think is a good space to make money.
Right. What are your thoughts on the way economic growth and earnings cycle actually is likely to pan out, Rajesh, going forward? Because again, because of the second wave, the economy has been hit and several quarters are scaling back the estimates. Next 3, 4 quarters, where do you see, not only the economic recovery, but also the broader corporates on their earnings front? Because you interact with a lot of corporates on ground. Do you see earnings growth to pick up pace from here on next couple of quarters?
Yeah, Ajay, you are right. So, from first quarter perspective, of course, earnings growth is going to be impacted, across sectors because, many shops are closed, the logistic issues and many more such issues. But compared to last lockdown, it's going to be much better because movements of goods and services is not restricted this time. Having said that, 1Q will be impacted compared to what Street is expecting currently. 2Q, probably there will be minor impact, and 3Q and 4Q, hopefully no major impact. But market is always, as I said, ahead of time. If you look at last 12 years, Nifty, the compounded Nifty delivered is about 6% or so. And if you look at even the Nifty earnings growth for last 12 years, it is roughly 5.7%. So market is nothing but mirror of earnings growth, and market is ahead of time. So when you look at investing, that's the reason why probably markets are already 10, 12, 15% correction you're already seeing from its peak. And there are many companies, many stocks across sectors which are down by about 20, 25% from its very, very recent highs, which they have done in January and February. So I think the stock price is already factoring in the earnings downgrade for FY22 due to special situations of COVID. But I do not see any material impact on numbers for FY23 and beyond. Right.
Rajesh, one last quick word on areas which are a complete avoid or are underweight for you. If you could share your strategy there.
Well, as we speak currently, we are a little bit probably, you would say, underweight on IT, we're a little bit underweight on pharmaceuticals, and commodity is a sector which we do not invest. So, of course, we do not have any, exposure to commodity stocks. So these are the sectors which we believe, there is, during economic recovery, there are many other sectors which gives a very superior growth compared to, this kind of a defensive names. So I think this year and probably another 1, 2, 3 years belongs to the strong economic recovery. So nothing wrong about these companies, IT and Pharma, all are very good companies. But probably the growth factor, it might be slightly slower or lower compared to, what we see on other side of the economy.
Right. All right, Rajesh, we'll let you go on that one. Thanks so much for your time.